I'll backtest the approach 200 times to demonstrate its high win rate. Let's start the video now. Without further ado, 3 indicators are combined for this strategy: the stochastic, RSI, and MACD. Since the stochastic will produce our primary entry signal, let's start there. The stochastic is an extremely easy-to-use indicator that effectively determines when the market is overbought or oversold. It is made up of 2 lines: the orange line, known as the D, and the blue line, known as the K. When traders use this indication, one of the most frequent mistakes they do is to trade the stochastic on its own. As a result, they purchase when the indicator reaches an oversold level and sell when it reaches an overbought one. You will receive a very low win rate if you continue to use the indicator in this manner. To further validate your study, you must instead combine the stochastic with other indicators. Now let's move on to the RSI, which is our strategy's second indicator. One of the most well-known indicators in trading is the relative strength indicator, RSI, which is often employed by traders as an overbought and oversold indicator. However, having 2 indicators that provide the same signals is somewhat pointless for this combination technique because we already have the stochastic to handle that task. Rather, we are going to use the RSI as a trend confirmation indicator. To achieve this, we must first modify each of these levels to 50 in the indicator settings. Now that we have a single line in the middle, it is very easy to use it to confirm a trend. If the RSI is above the line, it indicates an uptrend in the price, so you should only take buy positions. If it is below the line, it indicates a downtrend in the price, so you should only take sell positions. Let's now discuss the third indication, the MACD. One frequent technique to use the MACD, which is one of the most widely used indicators and excellent at detecting momentum, is to take a buy position if the MACD line crosses above the signal line and a sell position if it crosses below. This tactic, though, is only effective when the market is trending. The MACD frequently provides erroneous indications while the market is moving sideways. Because of this, we won't buy or sell using this combo approach merely because the MACD crosses over. Rather, we are leveraging it to ensure that the momentum is in our favor and to provide additional confirmation. The stochastic, RSI, and MACD strategies operate in this manner. Let's begin by discussing the entry signal. The first step in determining a buy signal is to examine the stochastic and watch for the oversold points on the K and D lines. Next, you want to make sure that the RSI is above the middle line in order to use it as confirmation of the rise. The next action is to wait for the MACD line to pass above the signal line in order to use the MACD to verify the rising momentum. After this, you still need to confirm that neither of the stochastic lines has reached an overbought level. If all the conditions are satisfied, you should enter a buy position. Next, let's look for sell indications. Once more, the initial step is to examine the stochastic and watch for the overbought point on both the K and D lines. Next, you want to make sure that the RSI is below the middle line in order to utilize it to confirm the downtrend. After that, you should wait for the MACD line to cross below the signal line in order to utilize it to confirm the downward momentum. However, before doing so, you should still validate that neither the K nor the D lines have yet reached the oversold point. You take a sell position if all the requirements are satisfied. Let's take a closer look at it. Similarly, if you took sell positions, you should set your profit objective at 1.5 times your stop loss and place your stop loss above the closest swing high. Putting your stop loss below the closest swing low and setting your profit objective at 1.5 times your stop loss is your exit plan if you took buy positions. We're going to take a buy position because the K and D lines on this chart are both at oversold. Next, you need to ensure that the RSI is above the middle line in order to validate the upward trend. In order to confirm the rising momentum, you must wait for the MACD line to cross above the signal line. Additionally, you must ensure that neither of the 2 stochastic lines has yet reached an overbought state. You take a buy position once all the requirements are satisfied. You now set your profit objective at 1.5 times your stop loss and position your stop loss below the closest swing low. Let's examine one more illustration. We're going to take a sell position because the K and D lines on this chart are both overbought. Next, you need to ensure that the RSI is below the middle line in order to validate the downward trend. The next action is to wait for the MACD line to pass below the signal line and ensure that neither the K nor the D lines have yet reached the oversold point in order to use the MACD to further confirm the downward trend. When this occurs, you initiate a sell position. Set your profit objective at 1.5 times your stop loss and position your stop loss above the closest swing high. I found a few adjustments and optimizations that you may use to further raise the strategy's victory rate. Limiting your stop loss is the first thing to do. Generally, you want to place your stop loss at the closest swing high when initiating a sell position. You can see, nevertheless, that the swing high in this trade is too distant from the price. As a result, you run an excessively high danger of suffering a significant loss. For this reason, I advise you to set a stop loss restriction of just 0.15%. This way, regardless of how far your stop loss is set, your loss will never be more than 0.15%. You can also view my other videos, and even though it just requires 2 clicks, it means a lot to me. I appreciate you all viewing, and I hope to see you in the upcoming video.